You know, every single business on the planet, from a tiny startup to a massive global corporation, speaks a certain language. It's the language of money, of performance, of health, and that language is accounting. Today, we're going to learn the basics of how to speak it. So let's pull back the curtain and see how the business world really keeps score. So let's just start with a really big question. You see a company, and it seems to be doing great, right? Lots of customers, cool products, you see their ads everywhere. But how do you actually know if it's successful? Is it making a profit? Is it growing? Or is it secretly hemorrhaging cash? I mean, feelings and what things look like on the surface, that's not enough. You need the facts. And that right there leads us to the most fundamental question in all of business. Are we winning or are we losing? It's a question that needs a constant, reliable answer. Without it, you're just flying blind. And look, this isn't just for Wall Street giants. We're talking about every single business, from the corner coffee shop to the tech behemoth. They all need a system to keep score. This information is absolutely crucial for making decisions. Should we hire more people? Can we afford that shiny new piece of equipment? Should we expand? You can't just wing it, right? The answers to these questions are found by looking at the financial score. So, that system for keeping score? That's accounting. But it's so much more than just crunching numbers. The best way to think of it is as financial storytelling. It's a structured way to tell the true, unvarnished story of a business's journey. So what does that actually mean in plain English? Well, you can think of accounting as a simple four-step process. First, you have to identify the important financial stuff that happens. Then you measure it, you put a dollar value on it. After that, you record it all in a really organized way. And finally, and this is the key part, you communicate that story to all the people who need to hear it. Okay, so this visual lays it all out for us perfectly. You see that flow? Identifying, measuring, recording, and communicating. It's this logical sequence that turns all the raw financial data into some seriously powerful information. Let me give you an analogy to see how it works. Think of it like baking a cake. Seriously, first you identify and gather your ingredients, all the sales, the expenses, the purchases. Then you measure them out in a common unit, like dollars. Next, you record the recipe, step by step, creating this permanent history of everything you did. And finally, you communicate your masterpiece by sharing that delicious cake, or, in our case, the financial statements. And what's wild is that these core ideas aren't new at all. I mean, not even close. They were first documented way back in the 15th century by an Italian mathematician named Luca Pacioli. And get this. He was friends with Leonardo da Vinci. The double-entry system he wrote about is still the rock-solid foundation of all accounting today. Pretty amazing. Okay, now here's something that trips a lot of people up: the difference between bookkeeping and accounting. Here's the simplest way to think about it. Bookkeeping is just one part of the process. It's the recording part. Accounting is the whole shebang. It's analyzing, interpreting, and communicating the bigger story behind the numbers. And this chart really breaks it down for us. You can see bookkeeping has a pretty narrow scope. Its main job is to get all that raw data ready for the accountant. Accounting, on the other hand, takes that data and gives it meaning. Its whole purpose is to produce those final reports, the financial statements that leaders use to make plans, forecasts, and really critical business decisions. So how does all of this work in the real world, day to day? Well, it all happens through something called the accounting cycle. Think of it like a factory assembly line that takes the chaos of daily business transactions and turns it into the crystal clarity of a financial report. The whole cycle kicks off with what we call source documents. You know, the raw evidence, like receipts and invoices. This proof gets recorded chronologically in journals, which are basically a daily diary for the business's money. From there, all those entries are grouped by type in a ledger. So think of it like organizing your diary entries into chapters, one for cash, one for sales, one for expenses, and so on. Finally, it's all summed up in a trial balance, just to make sure the basic math checks out before we move on. So what are these source documents exactly? They're really just the everyday pieces of paper or digital files that prove a transaction actually happened. An invoice you send out for a sale, a receipt for something you paid for, even your monthly utility bill. These are all the starting blocks for the financial story. All right, so once we've got our trial balance and we know the numbers add up, the next step is super important: making adjustments. This is for all the stuff that doesn't get captured in daily transactions, like revenue that you've earned but haven't gotten paid for yet. These tweaks and adjustments make sure the final picture is as accurate as it can possibly be, and only after that can we prepare the final product. the financial statements. And this is the whole point. These financial statements are the end goal of the entire cycle. Reports like the statement of profit or loss, which you might also hear called an income statement, tell you in black and white whether the business won or lost over a period of time. This is the final chapter of the story, and it directly answers that big question we started with. But wait a minute, who is this story even for? I mean, who's actually reading these reports? This is where it all comes together, because this information isn't just created for fun. It's made to be used by real people making really important decisions. So the audience for this financial story basically falls into two main camps. First, you've got your internal users. These are the people inside the company. And second, you've got your external users, which is pretty much everyone outside the company who has some kind of stake in how it's doing. Let's start with the internal users. These are the folks on the front lines. Management uses these reports to steer the ship, to set goals, check on progress, and make course corrections. And hey, employees might look at them too, to see if the company is healthy enough to afford things like raises or bonuses. Now, external users are just as important. Some of them have a direct financial interest, like investors trying to decide whether to buy stock or a bank figuring out if they should give the company a loan. Others have more of an indirect interest, like the government, which needs to know how much tax to collect, or even a customer who wants to check if a company is stable before they sign a big contract. So, if there's one thing you should take away from all this, it's that accounting is so much more than just math. It's a powerful, powerful form of communication. It's this universal language that translates all the complex activities of a business into a clear, understandable story about where it's been and where it's going. By understanding these fundamentals, you've basically learned the grammar of the language of business. So the final question is for you. Now that you know the basics, what stories are you going to start seeing in the numbers all around you? Thanks for watching.